want to talk about the latest piece that you put out. I'm a huge fan of your research. I tell people to go to the KKR website and read it all the time, and I'll say the same.
Okay,
but here's the thing. New reality, paradigm shift. People who think as deeply about investing in financial markets and, frankly, the economy as you do, don't throw those words around lightly. What do you mean?
Look, I think this is the first time in probably 15 or 20 years where we have an inflection point. And what we're trying to highlight is really a couple of things. One is we see a major shift from monetary to fiscal, which I think is a big deal. We've had all the central banks running the show. Now I think you're going to have government spending driving incremental growth. That's a big deal. It has implications for growth as well as rates and volatility. Second thing I would say is we're moving just globally. As you know, I travel all the time. The authorities with whom we speak, it feels like to me we're moving from global agendas to domestic. That has implications for trade in other parts of the world. The third thing, and I think you heard some of this last week, was we're moving back towards from re-regulation to deregulation, particularly as you think about energy, financial services, and I think healthcare will be in the mix at some point as well. And then I think you're moving towards a world where a lot of the volatility has been in the currency markets, really not in the equity markets. Equity market volatility has been periodically high, but generally on a sustained basis, most of the volatility has been in the currency markets as people wrestle with QE and devaluations of currencies. Our view at KKR is that's shifting more into the interest rate market this year and then probably over time into equities.
So people may look at those four, call them forces or themes that you believe are going to govern the macro environment and say, that sounds about right for the United States. Maybe it sounds a little bit right for the UK, where some of the same forces are already playing out with Brexit and a little bit of reflation. What about the rest of the world?
Look, I think this is what may be missed by many investors. I think there's been a lot of talk about Brexit, a lot of talk about President Trump. But if you think about China, I mean, based on our estimates, we think China's deficit right now is closer to 10 to 11%, not the 3% that's reported. It's a huge difference. If you take the first quarter of last year alone, they put $1 trillion of stimulus into the economy. You annualize that, it's about half of their GDP. So there's a lot going on behind the scenes where governments are trying to use fiscal to really get, I would say, some reflation. And so we've been in a period where we've had slow growth, monetary policy, disinflation, and that, in my mind, ended right after Brexit. And structurally, we think rates have bottomed. We think we're in more of a reflationary environment where governments are driving the outcomes. And look, that's going to create more volatility over time. We may not all be economists, but I think people can understand Fed jargon more than they can potentially what's being said out of President Trump right now or Xi Jinping or Erdogan. I mean, if you look around the world right now politically, we've got a lot of strong men. We haven't seen this in quite some time. I mean, just go through the list. Abe, Xi Jinping, Trump, Erdogan. These are people, Modi, they all have very strong agendas where you're creating some nationalist, I'd say, fervor, and that's even before I get to the continent and what's going on in Europe.
What about cycles, Henry? Because we've had this conversation before, right? We were many years into the business cycle already.
Exactly.
We were many years into the credit cycle. Don't those cyclical forces still persist?
I mean, I believe they do. I think, we've been kind of saying internally that, hey, it's hard to hurt yourself falling out of the basement window because we haven't really had much of a recovery. I do think that you'll get a little more growth, not as much as maybe as some think, but our view is we are pushing back. We're kind of 90 months into an economic expansion. Our view was kind of, I would say that 2018 was going to be the end. We think it's going to be a little bit longer. I think what's most important, though, for investors is that our job, particularly at KKR, is, we're not a macro shop. We buy companies, we invest in credits, we hold things for long times. We're trying to take the macro out. And so generally, we're never in the camp where we're going to put all our money to work at once or we're not going to do anything. I would say right now, there are certain sectors of the economy like autos and others that are late cycle, but generally, I don't believe it'll be the U.S. consumer this time that pushes us into a recession. In my mind, many of the concerns, we always look for where's excessive credit growth, and a lot of that has been, I'd say, come out of Asia, China in particular.
Well, let's apply it practically, right? How does that translate into a different asset allocation?
Okay, so I think there's some things that we would say are, must-dos right now, and I'll give you the view from KKR, and obviously you can digest it into, a broader capital markets. I mean, we're quite, in private equity, we're quite active in Japan right now. That is an area where we see the kind of deconglomerization, a lot of these multinationals. The Economist just wrote about that. We are as active as anybody there. That's a good business. We think even if Abenomics does not lead to great GDP growth, there is certainly corporate reform going on. And if we think over time the dollar goes up, that's not a bad hedge as well, owning yen-based assets.
What about credit? What about emerging markets versus developed markets?
Yeah. So I think our view on the emerging markets would be that after kind of 74 months, they are bottoming. Their deficits are
even in a strong dollar environment.
Yeah, and let me hear me out, which is I think what's happening is a lot of them, relative to the taper tantrum, real rates are much higher than they were in 2013, and the deficits are smaller. But I don't think you're going to get a V-shaped recovery, and I think more money is going to go into economies that are more domestically focused, things like Indonesia, where we've been quite active, or potentially India, where you have a larger consumer economy.
And quickly, credit?
Credit, it depends where you look. I'd say we are most active right now in what I call performing private credit. That's where companies who can't access the banks are coming to a firm like KKR, and that's a nice return. Generally, on the liquid side, we would probably say that high yield, in our mind, looks the most expensive. And the other area, I'd say German bunds. If you believe the data that's coming out of Europe right now, bunds look expensive, particularly relative to growth and particularly relative to the inflation rate over there right now.